All right. Well, good morning, good afternoon, or good evening, wherever you guys might be dialing in from. Thank you so much, Anka and Dave, for inviting us to this event. Always have fun coming out to your event, so thank you so much for that. I thought it was very interesting talking about the favorite indicators. And so I thought, this would be cool to kind of just share one of the things that we do. And hopefully, maybe it'll help you. I mean, we have a lot of speakers today, like Dave said earlier. There were some speakers yesterday. So at the end of the day, it's just a matter of making sure that you find something that works well for you or resonates with you and hopefully help you with your trading. So I hope I can share something in what I have been doing that has helped me with what I trade and how I trade. And maybe it will help you guys too with your trading as well. So let's go ahead and get started. Um, First and foremost, risk disclosure statements. This is something that is standard that needs to be said. We're not licensed financial advisors. So anything I talk about today is for educational purposes only. This is not a recommendation to buy, sell, or hold anything whatsoever. All right. Trading does involve risk. So please make sure you are aware of that. Makes sense? Okay. So I want to start off by talking about what we do and my approach to the market. My approach to the market is to find stocks that we can find at their lows, and then hold on to them until they rally to new all-time highs. And so, for that reason, you'll see multiple charts like this where we got into Dunkin' Donuts, which is a story in and of itself. Pretty cool story. During that time, Eli Lilly, Graco, Roku, buying them at these lows right down here. This is the semiconductor index, uh, restoration hardware. This is the S&P 500 after the pandemic. So our goal is to try to find stocks that we can identify at their lows and hold on to them till they reach their all-time highs. And so what ends up happening is you see stocks like these, where these are stocks that we traded throughout last year, and some of them again this year. We've traded multiple stocks with the same exact strategy and philosophy, buying them. And the cool thing about this is we did this throughout the pandemic. Actually, we started before the pandemic. Our goal in 2020, before the pandemic started, that in January 2020, was to do five per month, find five stocks that we can buy at their lows and hold on to them. We were willing to hold on to them for 6 to 9 months. Okay, 6 to 9 months. But we found out that we got really fortunate, and it actually ended up happening faster than that. It took approximately 3 months for most of them. And but anyways, we were able to buy them, hold on to them, and this was before the pandemic, during the pandemic, and after the pandemic. So been very successful with this strategy, and I hope that I can share that with you. Now, you saw how I pointed, to some of these charts up here, where you get down here and they go all the way up there. One of the biggest things we found out was that people get excited about the stocks like that made big moves. And so it led me to come up with this quote that says, the true credit goes to those who can train their eyes to see the setup. And so that was one of the biggest things that we wanted to do, was not necessarily focus on the results, meaning that after it's already made this big move, now people want to talk about it, but trying to find them before they make those big moves and get excited about the setups. And that was the biggest question, is that what was the unique setup that was common among all these stocks that have these big moves, regardless of whether it's on a daily chart, weekly chart, or the monthly chart. And so that's pretty much what we did. And so again, all these stocks that you see here were all based on that theory. That question we had in mind is it possible to find stocks at their lows consistently and then manage them until they get to the all-time highs? So before I dive into much of that, let me just share a little bit about who I am and what I've done. Um, we do more technical research, technical analysis research is what we do here. And I've been in the accounting, finance, and investing background in that field for about 17 years. The last 8 to 9 years in particular, I've been focusing more on technical analysis and quantitative analysis. Now, prior to that, when I went to college, I went to college for accounting. I came out of college, I was working as an accountant, and I ended up working for a mergers and acquisitions company where my job was to analyze the financial statements and see how good or bad the company was based on their financials. And if they were good companies, I recommended it. If it wasn't, I let them know that it wasn't a good company. And so that's where I started from. And then when I decided to go off and do my own entrepreneurial stuff, I realized that I could actually approach the stock market in the same way, which is analyzing the financial statements of companies in the stock market. So I started doing that. And then I quickly realized that it didn't really work quite as well because I realized that there were companies that we found to be undervalued, major undervalued stock. But for whatever reason, we could not figure out when it was going to move. Okay. And so it was one of those things, okay, I see this company is undervalued, and we held onto some companies for 2, 3 years. And it's like, oh my gosh. And then we seen other companies that were totally overvalued and just skyrocketing like crazy. And I was like, well, what gives? Like, this is not fair, because everything we learned in accounting and, understanding finance was find undervalued companies. But it's like, now you're sitting for 2 years and they're not moving. And the ones that should be going bankrupt are the ones that are moving. And that's when I found out about what is called technical analysis. And I was like, wow. So I wanted to find out more. I wanted to learn more about that. And that's what got me into technical analysis. The more I got into technical analysis, the more fascinated I became. And before I knew it, I started connecting certain dots together with technical and financial analysis and how you can see that on charts. And I hope I can show you a little bit of that today. So once we perfected our model, we started focusing on identifying good companies, but still has that attractive price with low risk and a good potential for capital appreciation. At the end of the day, that's what we want to do. And so our research led us to focus on the price movements and patterns on major indices, ETFs, IPOs, dividends. We focus on earnings seasons. We get really excited about earnings season, which we are in right now. We're in earnings season. And then just certain cycles in the market as well as stock splits. Okay. So that's a little bit about us. And so in essence, what we did, and I want you guys to please understand, our system is not based on the typical hindsight analysis, like, oh, I could have bought it back here. I should have sold up there if I would have just done this, da 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 da. Instead, it's more about using today's data, what we're seeing today, and how do we stay on the right side of that market with the current data that we see. And I get this a lot because I'll find people will say, okay, yeah, the way this market looks right now, I'm going to sell. And then they come back 2-3 weeks later and, oh, I should not have sold. Oh, I should have just held on. And they think it's them, but what they really realize is like the flaw is not looking back the flaw is that they're looking back in hindsight. What they should have done is said, what was the current data that misled me, or the current data that I should have seen that would have told me to hold on to this or get rid of this. Okay. So rather than looking back in hindsight, and because anybody can look back in hindsight, my kids, I have a 9-year-old and 7-year-old, they can look back in hindsight and see, the perfect entries in hindsight. The key is learning how to identify data, current data right now, that would tell you, yes, this is the right side of it. And then if things start going wrong, how you can quickly tell things are going wrong so you can get out of it. Okay. So I'm going to walk you through the system that we use today that has allowed us to get these great results that I showed you. But the one thing I have to say is this is not for it's not a quick, fast way of making money. I'm just going to be honest with you. You heard me say what we realize is that we hold on to some of these stocks for up to 3 months. So if you are not willing to do stuff like this, I'm going to let you know my style might not work for you. I know that I might lose some audience just based on that testament, but I'm just going to be honest with you. That's the reality of it. And so what I usually tell people is, look, if you are one of those that want to day trade and all that stuff, that's no problem. But I encourage you to also have a different account where you can have for more swing trading as well as long-term invested. But people who are interested, who are willing to do swing trading and long-term invested, where you only trade once a week, maybe even once a month, and you're willing to hold on, and all you have to do is just manage your trade once a week until it gets to its destination or the target and produces the same profit potential that you're looking for, this will work wonders for you. Okay. I tell people, I said, those who have kids and are trying to build something for the kids, those who are looking to build something for the retirement while you still have your, regular 9 to 5, this would be the type of strategy that I believe would help you. Okay. So just keep that in mind. If you're one of those that have to sit in front of computers and you want that adrenaline from, market movements and volatility every minute, every hour, it might not be the best for you. Okay. But everybody's different. So, like I said, so since last year, we've done about over 145. I think at this point, we're about 158 at this point now. This year we're at 50. We've done about 56, 57 stocks so far this year. Last year we did about 98. Okay. Our goal was to do 60 for the year, 5 a month. We ended up doing 98. This year, our goal is to do 100 this year. And we're around about 56, 57 at this point. Okay. And with the current condition of the market, this is one of the reasons why we're excited, because this is the time we go in and find and scoop stocks at low prices and expect them to reach new all-time highs. So very, very excited about what happened in the market this past week. And so we'll see how that goes. But at the end of the day, our goal is to use technical analysis and some quantitative analysis to select healthy stocks at attractive prices, like I said, which also helps us reduce our risk, but at the same time gives us good price appreciation. Okay. So when I was trying to put this together, what I wanted to know were 3 things. Is there a way to find a setup that can help us consistently get into stocks somewhere around the bottoms? It doesn't have to be the exact bottom, but somewhere around that low. And I have to clarify what lows is, and we'll discuss that pretty soon, because lows, we need to quantify and just, clarify what we consider to be lows. Okay, so I think that's something we'll address too. But then once we know that, then the next question is, when do we start buying these stocks? I mean, because again, from my past experience of being in stocks that were undervalued, and they went for 2 years just staying undervalued. The question is, when should we start buying these stocks? A very good example was what happened in the pandemic last year, where a lot of people bought a lot of these airline stocks. And for months, almost I think 8 months, they just wouldn't move. Unlike stocks that were in the tech sector, the stay-at-home stocks that were just skyrocketing like crazy. So there was something that was different about the two of them. And the key was, that was part of what we wanted to learn over time, is like, when do we start buying these stocks? So we'll talk about that too. And again, making sure that we can do it based on current data, not in hindsight. And then how do we stay on the right side of it throughout the rally? And if something goes wrong, how do we make sure that we know that something is wrong and we can get out as soon as possible? Because I've seen many times people make all this profit only to give it all back and more. Okay. And that's comes down to the fact that you don't understand when things have shifted, right? So we don't want to play the game of wishing, hoping, and guessing. There's enough data to tell us information that we can act upon. And so that is what we wanted to do. So our very first discovery, which was, how do we see these setups? We realized that it's actually easier to identify the beginning of a new trend than most people might think. And the reason why is because the stock market is not random. Now, anybody who knows me would have heard me say this multiple times. I say this over and over because I try to drill this in people's head. The stock market is not random. And I have this guy to thank for that. If anybody's ever met this guy named Jim Simons or heard about this guy named Jim Simons, I have never met him in person. He doesn't know who I am. I just know of him, but I really like the work that Jim Simons did. And quite frankly, it was because of Jim Simons. He was the first one I heard say the market is not random. All right. And Jim Simons is a multi-billionaire. He runs a hedge fund um, that is in the billions. And everything was based strictly on patterns, like no fundamental analysis whatsoever, just strictly on patterns. What he did, he was he is a mathematician, but he basically hired physicists, statisticians, and math experts to help him use this information to identify patterns in the market. And so they built this big old computer algorithm that can identify and spot these patterns based on statistics, math, physics, and that's what they did. And they've been doing this since the 1980s. So it's kind of interesting that this has been going on for quite some time. But he said, don't get caught up into intuition, follow a proven model. And then he said part of the model is that he understood that patterns of price are not random, even though they might seem like they are random, they really are not. Okay. And then he says what they do is they search through historical data, looking for patterns that would not, the key word is would not expect to occur at random. So what he's basically saying here is if anything happens by random, they don't even want it. They don't want it. It has to be so random, so predictable, or else they would not trade that. So me understanding and hearing that and seeing what Jim Simon was talking about, I was like, wow, what are some patterns that are not random in the market? And if I can build my trading strategy just around patterns that are not random, that occurs over and over and over, that are so predictable, then we can do something that's similar to what Jim Simon is doing. And so that's what started my whole research. And so let's get into this, because one of the first things that I started realizing when I was looking for these patterns, I realized that, remember like how because of my financial analysis and what I've done understanding companies, what I started realizing was when I analyzed the financial statements of different companies, I said, wow, this is a great undervalued company, or this is a great company. This is a good company. There's nothing wrong with this company, da, 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 da. As opposed to the ones where after running the financials, I was like, wow, this is a horrible company. One of the things that I noticed when I went back and looked at the charts was that over the years, the great companies, all of them had the similar pattern of trending higher. Now we'll think, okay, that's a given. But literally, I got to the point where I said, wait a second, I can literally, what it took me 2-3 weeks, sometimes a month to analyze through the financial statements, I can go to a stock, go back the last 10 years and just look to see what it's been doing. And if it has something similar to what you're seeing right here, where it goes up like this, I can bet your bottom dollar that the financials make sense and that is a great company. Okay. And so what I did end up doing and what you guys are learning now is like, again, the pattern is so predictable that when you see companies that has stood the test of time over 5-10 years and have been doing this, now they're going to go up and go down, but net, they've been going higher and higher and higher. You can bet your bottom dollar that these are good, healthy companies. And so that's one of the things we wanted to do was look, from now on, we're only going to focus on stocks that has been in a long uptrend. All right. 5 to 10 years is usually where we want to see them. If it's before 5 to 10 years, there's a whole different method that we go through, which is beyond the scope of today's presentation. All right. But that was our goal. And we wanted to see along the way that they've had some type of pullback, some type of retracement in that period of time. So if we see those, bingo, we now have a stock that can meet and repeat the same patterns that we're looking for. So that was the first thing. The next thing was, okay, in order to buy these stocks at attractive prices, we have to do one thing, which is we have to wait for the retracement to take place. And one of the things we came to realize is, I remember, and I'll go into that story soon, but I remember when I first started trading, my mindset was so bearish because everything I listened to, and maybe I just drew that to myself, was a crash, a crash, a crash. That's all I knew about the stock market. Oh, it's risky to be in the stock market because of a crash. And so everything I listened to, and I guess Google and YouTube didn't help back then, because actually YouTube wasn't really helpful back in those days. But everything that you learned was, oh, crash. And maybe because, again, like I said, my bias was to the downside. So I focused more on those kind of stuff. But what I realized is that in a good, healthy company like this, the pullbacks are just that, pullbacks. And we have to treat them as pullback for sure. Once I came to that realization, I said, look, first, I don't have to worry about, oh my gosh, crashes anymore. And this debate between, is it a true reversal or is it just a retracement? For now, any good, healthy company that has been trending like this, when it starts coming down, I just see it as a retracement first. And then the second thing, which it allowed me to do, was focus on, wait a second, rather than worrying about, oh my gosh, it's going to go bankrupt, good, healthy companies like this don't necessarily go bankrupt. Instead, what we should be doing is focusing on, wow, when is this pullback going to end? Because there's going to be huge buying opportunities there. Okay. And that's when we decided, interested enough, this is what the low price means. And when I say, attractive prices, and this is when I was talking about earlier, of like low, we have to define what low is. I had some people say, well, that's not the lowest price. The lowest price is this down here. Well, okay, I get that. But at the same time, when this rallied up and pulled back, this was the low for now. And when this rallied up and pulled back, this was the low for now. Was it lower than this low? No, but that's the new low. Okay. And that's what we consider to be attractive prices. So, not necessarily say the lowest price down here, but attractive prices usually are lows that are higher than the previous low. Does that make sense? And if you think about any uptrend, this is a classic definition of uptrend: higher highs, higher lows, higher highs, higher low, higher highs, and then what? Higher low. And so at a glance, I can see, without even having to go back to my college days of doing accounting and studying the financial statements, if I see a company like this, I'm looking at this and saying, well, this is a great company. I bet you if I do the financials and study the financials, they'll come out to be good companies. So now that I know this, the only thing I have to focus on now is, when are we going to get that retracement so we can start focusing on the attractive price? Make sense? And we also realize that if we focus on these attractive price, then we are reducing our risk. And I was like, wow, that makes so much sense. And so what we end up doing is, look, we'll only trade qualified uptrending stocks, only focus on the retracement entry. And what we wanted to do is, what we said, no more breakouts. We don't want to find the breakouts. The key now is we have to be in before the breakout takes place. I'm not interested in any stock that has made new all-time highs unless we were already in that stock before it made new all-time highs. We stay away from headlines, because headlines typically 80-90% of the time focuses on stocks that have made new all-time highs. And so it draws people in after the fact. And so we said, stay away from that. We wanted to stay away from illiquid stocks. We wanted to stay away from stocks that have a huge price spike. Okay. So if you see stocks that spike 100% in one day, or 200% in one day, or even in a week, we say we don't want to be in those stocks, because just as much as they spike up, 99% of them will strike right back down again. Okay. So it becomes too risky, too volatile. Say, don't worry about that. We want the slow and steady type of stocks. Okay. And for that reason, we figured out that penny stocks, a lot of penny stocks do that. So we try our best to stay away from penny stocks. We might trade some penny stocks, but most of the time we try to stay away from penny stocks. Okay. And again, it's very simple for us. The reason why we were able to make new all-time highs is because we knew that if we bought here and it's a stock that is a good, healthy company, that it would take out the new high. It's as simple as that. Okay. If it pulls back down here, it should take out the high. If it pulls back here, it should take out the high. And that's all we've done. And that's the way that all those stocks, over 98 stocks in 2020, about 57 right now, that we have done over and over and over again. Okay. That's what we've done. And so this is our goal, is to find stocks that are healthy, catch the pullback. Sounds simple, right? Yes, Godfrey, this is being recorded. Yes, this is being recorded. Does that make sense? So it's it's simple. And that's why it says it's simple, which is funny because everybody knows this. But for some reason, we haven't really paid attention. And so usually I would do this, and I should have done this earlier, but I would ask people, say, and indulge me if you can with this. Um, and if you know that, if you've heard me say this before, don't worry about answering this. But for those of you guys who've never heard me say this, let me ask you this question and see if you guys can answer this question. How many corners does a stop sign have? How many corners does a stop sign have? Anybody knows? Just type that into the chat box. How many corners does a stop sign have? This is very interesting. Okay, wow. All right, you guys are super smart, because honestly, I'm just going to be dead honest. This is the first time where everybody's response is exactly correct. Okay, everybody's response is exactly correct. It's 8 corners. Usually in other presentations, I'll have people say 5. I'll have people say 6. So good, very good. And now, indulge me one more time, maybe 2 more times. What color is a stop sign? It sounds very simple and basic, right? But I'm leading somewhere with this. What color is a stop sign? Anybody knows? Okay, so I'm seeing red, which is true, but the answer really is red and white. That's the answer, red and white. Very good, James. Okay, great. Adebutu, I know your name. I've seen your name before. You're Nigerian, which I am too. I'm a Nigerian too. I was born in DC, but I grew up in Nigeria. Very good. Excellent. All right. So we know this now. All right, red and white. Great. So now let me ask you 2 more questions. The next question is this. What about a yield sign? How many corners does a yield sign have? Most people usually get this one right, but you just never know. 3. Excellent. Now, last question. Last question. What color is a yield sign? What color is a yield sign? Last question. What color is a yield sign? No cheating. Don't go back and look at, the internet or anything like that. Okay. So this is where, I kid you not, this is where we get a lot of mixed answers. Now, most people would say yellow and black, and you guys are wrong. You're completely wrong. The color of a yield sign is red and white. Some people say, oh, well, in Canada, no, in Canada, I've had Canadian students tell me the same thing. I've had Australian students tell me the same thing. The color of a yield sign has not been yellow and black since 1972. So anybody who has been driving after 1972, and maybe in Africa, right? No, believe it or not, it's red and white too over there. Okay. But the question is, wait a second, if the yield sign has not been yellow and black since 1972, how is it that we drive every single day? We pass major intersection and corners every single day, and we think that it's still yellow and black. Some people argue with me, no, I said, I promise you, go on the street today after today's presentation, tonight or tomorrow, whenever this whole series is over, go out and drive and look at every yield sign you come across. It has not been yellow and black since 1972. So the question is, how did we mistake that? Something that has been there, we pass by it, it's obvious, it's never changed, it's been staring us in the face over and over for years on and year on and year on. And we still never really paid attention to it. Ladies and gentlemen, that's the same way this is in the market. The key to being successful in the market has been staring us in the face over and over. We've read about it. We've taken tests about it, just like people taking driving tests and everything, right? We've done all this, but for some reason, we're not paying attention to the detail, is what it comes down to. And so this is what we discovered. It's like, it's not rocket science. It really is simple, but it's that people overlooked a lot of pertinent information. And so, again, this whole concept of uptrend, downtrend, it's not then new, but people have missed and overlooked so much power in the definition of an uptrend and downtrend. Okay. I'm going to take you back to when I first started in 2013. Um, Here is the chart of the market in 2013. I was so focused on a bearish market that I shorted and kept on shorting and kept on shorting and kept on shorting and kept on shorting to the point that I blew my account. Okay. I went back, got some more money, came back in the market, blew my account again because I believed that the market was going to crash because I listened to people who were, primer bears saying that the market was going to crash. So after the 2013, I lost my account. I blew my account 3 times. In 2014, I looked back and said, man, what did I do wrong? And this is where I started noticing, I was like, wow, I mean, 2013 was the worst year for me ever. And I went back and I said, man, if only I could have bought down here. And if I bought here and I bought here and I bought here and I bought here, wow, would I have made money? And the answer is yes, you would have made money, Wally. But the problem was, I look back and say, well, how could I have figured out this was going to happen? Or, you know what, maybe 2013 was just a lucky year. And then 2014 came and I noticed the same thing. And then this is when I started doing a lot of my research. By 2015, I noticed we had the same thing. And even after a big drop like this, we still could have picked the bottoms. By 2016, we were on fire. 2017, same thing. 2018, everything was good up until October. But again, we realized it really wasn't different. It was the same thing. 2019, the exact same thing, realizing that a healthy market will have pullbacks, but they will always recover, ladies and gentlemen. Okay? They'll have a pullback, recover, pullback, recover, pullback, they recover. And every time they recover, the one thing they do is what? Take out new all-time highs. And this is how we were able to do 98 of them. And the only reason why we could only do 98 was because we didn't have enough money left. I mean, I tell people now, I say, once you understand this, the challenge you have is not losing money. The challenges you will have is you don't have enough money because you will see so many opportunities and you cannot trade them all. Okay. You won't be able to trade them all. That's the challenge we face now, which is a good challenge to face. It's not about losing money anymore. More so than it's, wow, how do we get more money to take advantage of what's going on in this market? Here was 2020, even with the pandemic drop. This is the pandemic drop that you see right here. And when this hit bottom on March 23rd, which we saw, we just did the same thing as time went on over and over and over until, and people were perplexed. They were shocked that it went to all-time highs, but not us. Okay. So this is what we end up doing. And what we end up finding was that a new trend can begin. And so we took all that information that we learned and we put it together in a platform that you will be learning more about. In this platform, we call it the right side platform, right? It looks something like this. Let me bring the screen here. This is the right side platform. This is the S&P 500 as we speak right now. And what we discovered was that markets have very cool, clear, concise information when the new bullish trend begins. And so what we did was we took all that information, put it in our computer program, had our programmers use algorithms to calculate all this stuff, and then just give us one very cool thing, which is turn this background into green or red. When the new bullish trend begins, it turns green. When the bearish trend begins, it turns red. This, ladies and gentlemen, is literally the S&P 500, what happened just previous, like this week. So this is why I said we were expecting this to happen. And so when this started trending down, this is what we want to see because we need to see a bearish trend before we can take out new highs. And so when this started dropping, was like, yes, another one. Why? because we know the market has been healthy. Here is the daily chart. Here's a 1-year daily chart of the same S&P 500. And what I want you guys to see is that, look, the same thing has been happening. Up, down, up, down, up. Well, maybe we'll go up like this, or have it down, up, down, up, down, up, down, up, down, up, down. So as clear as a night and day is going to happen, as much as we know right now where I live, it's daytime. I know it is predictable to expect evening and nighttime to come. And that's what we learned. And so because we now know this, we have the information, the data to tell us, well, this is the beginning of a new trend without looking back in hindsight. And so right now that we have this bearish trend, great. We know that very soon we'll get another bullish trend. And ladies and gentlemen, that is what we're looking for. And so Brad is asking, so since you are in an uptrend, you just focus on the long side. Absolutely. Why? I even had this with some of my students, the brand new students that we had, and they was like, why not short? And I said, well, the way we see this now, after so many experience, is you better off trying not to short in a bullish market. Does that make sense? It's going against the tide. We would rather let the drop, because what we found is the drops don't last long. They might be ferocious, they might be big, but they don't last long, is what ends up happening. And so for that reason, we say no shorting in a bullish market. And you can even see right here. Yes, you might have had, this is probably one of the longest drops right here. But do you know how long that actually takes? That literally takes anywhere between 1 to 3 weeks at the most. That's it. 1 to 3 weeks at the most is what you're looking at. That's okay. What is it to wait 1 to 3 weeks and then recover all of that and more? And so when the market starts dropping, believe it or not, this is when we say, let's go take a break. Let's go take a break. Let's refocus. Let's rebalance our portfolio. Let's make sure we have money in our accounts so that when the market is ready to turn positive again, we can jump on that. Does that make sense? So yes, Brad, that is absolutely correct. So all I'm saying is we've now taken that and made it where we can tell when things are happening as it is happening, not in hindsight, but as it's actually beginning to happen. So that within a day or two, boom, we can jump into these. And our goal, like I said, is to make sure that we buy early. Don't buy after the breakout. Our goal is to get in before it breaks out. And then just hold on until price tells, or the platform tells us it's time to get out. Make sense? Okay. So going back here, the second thing we discovered, which was the question we had, when should we start buying these things? Okay. And the idea is we wanted to make sure that we bought in the low section of it without having to guess. How do we know this is the low, this is beginning to reverse? How do we make sure we don't get ourselves into trouble? And here's a snapshot. I'm going to go to the platform, but the idea here is I'm going to introduce you to another indicator we decided to create that can help us with that, which we call the Harp Line right here. And our thing about the Harp Line is once we have this green section here and prices in the lower section here, and another thing we created was something called a right model with a buy cover. Without question, we know we're buying at a low discounted, attractive price. Does that make sense? And so right now, let's go back here to the platform. If I go over here and put on this Harp Line, this is what we're talking about. And our goal here is, I want you to see something. When price, if I move my mouse, you'll see, just notice how the right model keeps on changing, right? And so right here, when it was saying sell short, one, we would not have sold short because of the fact that the right model was saying this is a bullish market, not a bearish market. And so we know any drop here can be very short-lived. One, two, we want to make sure that we are buying inside the Harp Line. This was outside the Harp Line. So we knew that that was a false signal. Next thing is we waited. The very next day, it says exit your long position, place stops on your short position. We come here. This is what we're looking for, ladies and gentlemen. We want to make sure that price is in the lower section here with a buy signal. That is, when we see that, we know we are getting a discounted, attractive low price. Now, keep in mind, it's not as low as the low down here, but we know it is safe enough. Market is getting ready to trend. We can see that it's bullish because of the green background. We are in that vicinity where we know it's safe to start buying, and our right model tells us it's time to buy. Right now, here's where we are. Exit your long positions, place stops. We're still bearish in this sense, but the cool thing is we are in this section now. So we just need to wait till the market ends today. We'll see, and by tomorrow morning, we'll know whether we should start trading. Now, some people say, well, but you missed yesterday's rally and you're missing today's rally. Not to us, because just as much as we miss this rally here, and we didn't get in until the end of the day here, which was really the next day on this red candle, did we not make money? Yeah. See, the key is not, again, getting the absolute bottom, but getting in low enough before the breakout so that we can capitalize on what is about to take place. Okay. Then next is, how do we tell when it's time to cut our losses short and let the winners ride? And again, this is where the platform helps us. We've put that all into the platform now, where we can come here, and just like we had a buy cover here, we know that as long as we don't get a sell, as long as we don't get a place your stop, market is still doing okay. And so in this case, and as well, as long as we don't get a red bearish trend beginning. So right here, it was time to buy. You could have bought more there. Right here says wait and hold. Now we typically say the first two wait and holds, if it's still within this lower section, is okay. After the second one, no more. But at this point, what it's basically saying is wait and hold, meaning that, don't chase the stock. That was another factor we want to put in. How do we make sure we're not chasing something? And so when it says wait and hold just simply means if you're not in, wait. You've missed it. Wait for the next one. And if you're already in, what it's saying is just hold on to it, because so many people say, oh, this is the resistance, let's sell. And I'm like, whoa. Before you start selling that resistance because you're scared, because you don't know what's going on, now we have data that can help us see we don't have to panic. It's a wait and hold. And if you understand the concept of what I talked about earlier, where the classic definition of an uptrend is this, then you should not be expecting it to hit this and come back down. You just shouldn't. Now, when it tops out, I get it. Okay, you're worried about, oh, when it tops out, no problem. All right. That's where this platform comes in, because if when it gets to that resistance, it starts telling us to place a stop, sell, then we know we get into a point where we're topping out. But otherwise, what ends up happening, and if these stocks have been doing it for the last 5-10 years, then chances are, again, they're good companies that are doing well. That's all they know. It's defaulted to kind of keep on going higher. And so if we buy down here, we can expect it to surpass the resistance. See, that was my problem in 2013. Everybody's all resistance is going to come back down. But the mistake they made was they didn't realize we were still in an overall bullish market. Okay. And so, because the market had bottomed in 2009, but again, we expected to take out these highs. And that's literally what we did. We did 98 of those last year. We've done 57 of them, 56, 57 of them this year. Same exact concept. We don't concern ourselves with, oh my gosh, resistance, let's short. And once it starts pulling back, we know that we're dealing with retracement. We're focused on when this turns green. So this is literally what we're waiting on right now, ladies and gentlemen. Tonight, we would know whether this turns green or stays red. And I'm here to say, if it turns green tonight, it is time to buy. Okay, if it turns green tonight, starting tomorrow morning, I mean, we're already ready. I've been telling all our followers, get ready, get your money ready. If it turns green, be ready to start buying. Okay, and what we'll expect is what? New all-time highs, just like that. But even if it doesn't and it runs into problem, we know that the platform will let us know. So as we kept on going higher, wait and hold, wait and hold, wait and hold, wait and hold. I'm not sure how many people realized 2, 3 weeks ago when we had volatility in the market, when we had this market pull back. What did it say? Wait and hold. The next day, wait and hold. We had a big drop in the morning. Market looked like it was going to tank. There were so many people selling. I looked at the platform. Platform said wait and hold. I said, well, there must be reasons why it's saying wait and hold. So we waited, we held onto our position, we didn't sell, and we were rewarded the next day with new all-time highs. And then it started going up, 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 up. And then right here was the very first time we saw a long stop. I was like, uh-oh. And guess what? It changed from a bullish trend to a bearish trend. Right there, I was on a call last week, Thursday, live on a call. And I say, ladies and gentlemen, it was in the evening. So it was after the market had closed. We've seen this. I showed it to him. I said, do not be surprised that the market starts dropping. You place your stop, you would have been stopped out the next day. Boom. What's happening this week is not coincidence. We expected it. It's what we do. That makes sense? And so it's not hard. The only thing we've done now, and the reason why we actually did this because and put it in a platform because so many people would do the analysis that we used to teach when we used to teach this. They'll do the analysis, but then their biases gets in the way, and they start, it's just the way human minds are. They start disregarding certain information and certain analysis they need to make because they want the market to go that way. So I said, you know what? No, no, no. If we let the computer program this, and the computer does it all, the computer has no biases whatsoever. It will tell you what to do and what not to do. And so all you have to do is just simply come, you look for 2 or 3 things. One, are we bullish or bearish based on these backgrounds? Second, where are we in the Harp Line? Third, what does the right model say? And the way I created the right model is, making sure that it's just one word, meaning that we're not saying, oh, maybe you should buy and place some stops. It's just one thing, one action, I should say, one trade action. So why not buy now is what William is asking. A very good question. The reason why we're not buying right now is because we want to confirm that this is truly the beginning of a new trend. That's all. And we'll find out tonight. Okay. Because have you seen situations where market drops when we have a fake rally for a day or two, a relief rally is what they call it, right? A bearish, what do they call it? A bear market rally, right? Where it just lasts a couple of days and then it falls back down again. That's what we're trying to avoid, right? And that's what we program into this because I've been caught in those type of situations many, many times, especially in 2013, 2014, I believe. Okay. Let me see if I can actually show you this. In 2014, let me see if I can find the chart in 2014. This happened to us, and that was the reason why. Right here, when all this was happening here, okay, this big drop right here. That's what I wanted to avoid because this was a very big lesson for me. See how we had one big candle there, the next day followed by green, another big candle followed by green, red, next big candle followed by red. That's what I want to avoid. But then when we start having this, yes. So to avoid that choppiness that might look like, oh, we had a big day in the market yesterday, so it's going to continue today, we make sure that we factored in some more data that would tell us, yes, the trend truly is beginning. Okay. And that's kind of like what we're doing here. And that's the reason why we're waiting. And again, by tonight, we'll know yes or no whether it's time to start buying. Okay. And if it's not tonight, then we'll wait till tomorrow night. But the key is we're not worried. We know it's coming. That's the beauty of it. We just have to be patient and get in when everything is all clear. Make sense? So because of that, we did trades like Tesla back in 2019. You can see this rally. Dunkin' Donuts, like I showed you, we got in Dunkin' Donuts somewhere around here after the pandemic, which was pretty cool because when we owned Dunkin' Donuts, unfortunately, Dunkin' Donuts got bought out. So we had to like exit our positions on Dunkin' Donuts, but we had a great blast. The Dunkin' Donuts, Starbucks was one of the two that still existed during the pandemic, that was still open, I should say, during the pandemic. And so I remember when we had Dunkin' Donuts shares, we were just happy because the shares were making money. Dunkin' Donuts was there. It will always have a long line, and we were patient. We'll just sit in the back of the line. Oh, go ahead. Anybody wants to cut in front of us? Go ahead. Go ahead because the more you guys buy, the more our shares are doing well. So when they announced that they were getting bought out, I was like, it was bittersweet. It was sweet in the sense that we made money, It was bitter in the sense that, man, now we can't go to Dunkin' Donuts with the same excitement like we used to have anymore. Okay. RH, this is a company that we actually found that we found out about because of Warren Buffett talking about this stock. And then we went there and we looked at the chart, like, wow, same thing. Okay. And a lot of people give Warren Buffett a lot of criticism for his airline shares, but most people don't know about stocks like this that are doing phenomenally well. Okay. And Starbucks was another one that did just as well as Dunkin' Donuts. But again, the idea was that we were buying all these somewhere down here. So yes, we didn't buy down here. No, we did not buy down here. Matter of fact, we didn't. We probably bought somewhere around here. But the one thing we knew was that it was going to do what? Take out the high. That makes sense? So here are some things that we found along the way is that if you understand this concept and you focus on certain stocks that follow this concept, but making sure you understand there are some key times to pay more attention to these patterns than others. Okay. And that's why if you've ever seen where you traded something before and then you try to trade it again and it didn't work, chances are you were lucky enough to be in one of those key opportunity times when it really, really works. And then the next time you try to trade it, that opportunity wasn't there anymore. So we found that around earnings season, before, after, especially after earnings season, one of the best times to go out there look for these opportunities because a lot of these earnings dropped in price. Good time to go look for them. When they declare dividends, when companies declare dividends, there's a whole nother strategy around that. Stock splits, seasonal cycles, major market retracement like we just experienced. That's what we are dealing with right now. We're dealing with the major market retracement right here. And when I say major market, it's because all of them, the Nasdaq, the Dow, the Russell, the Dow Transportation, the S&P 500, all of them are going through a retracement right now, which is what they've done. So when those things happen, rather than panicking and saying, "Oh my gosh, the market is going to fall," there are some key opportunities here if you know what to look for. Same thing with IPO stocks when they become seasoned, not in the beginning, but when they become seasoned. All right, and so on and so forth. Interest rate, same thing. Right now, believe it or not, it is happening in TLT right now. Okay. That is literally taking place right now. The setup is like corporate bonds, same thing. That's one of the things we actually talked about this past week to our subscribers, like pay attention to corporate bonds because they are ready to do something. And it's very interesting because Kathy Wood even said it too. And that's how, I heard Kathy Wood say something about that. And I was like, let me go take a look at the chart. And lo and behold, it was happening. Make sense? All right. So any questions you guys have? In the meantime, while you guys are asking those questions, I'll tell you about my offer, inviting you to come use this software. The platform is called the Right Side Platform. If you go to this link right here, rightsidetrading.com, you will see the platform for $2.99. But if you put in this /deals, you'll find the deal that I'm going to offer you guys for testing it out, trying it out, and see whether you like it. Okay. This is the deal so rather than $2.99, you get it for $97. Thank you so much, David, for that. You get 30 days access to the platform. Like I said, if you go to our website right now, rightsidetrading.com, anybody that was to walk on there, it would charge you $299, $300. But I'm doing this for you guys for $97. And then I'm going to invite you to a live webinar on Tuesday evening, this coming Tuesday evening, where we go into more details because I didn't show you all the stuff the platform can do. Part of that is, how to use seasonality with that, how to use the scans, how to run scans so you can actually find these stocks, stuff like that, and just go into more details on how the platform works. So you come to this live workshop, I'll show you that, I'll show you how you run your scans, all that kind of stuff, to kind of help you with your investments or your investing. The other thing I'll do is I'll give you the right side report as well. Let me talk a little bit about this right side report while I have a few more minutes left. This right side report is, does it support Canadian stocks? Yes, it does, actually. Yes, it does. So we do have Canadian stocks. We have stocks listed on the TSX, so the Toronto Stock Exchange, but that's the only one. I'm not sure if Canada has any other stocks that are listed outside of the TSX, but we do have the TSX. Unfortunately, we don't have the Australian. For anybody who's from Australia, we don't have those yet. And Yeah, so we have the American Stock Exchange, we have the NASDAQ Stock Exchange, not the NASDAQ Index, the Stock Exchange, NASDAQ, and the NYSE, New York Stock Exchange, as well as the Canadian Toronto Stock Exchange. Okay. This right side report, I want you guys to see this. This was back in January 2020, right before the pandemic. Okay. Because of what this platform has done, we were able to tell on the 24th of January that something bad was really about to take place. Okay. Something bad. Now, we were not like those people who's like, prime of bears, and then, they've been bearish for like 8 years. And when it finally happens, they see, we told you. No, 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 that's not us. Okay, we are more often than not, we're bullish than we are bearish. But in January 2020, I wrote the report because we started seeing some major warning signs on all the indexes. And that's why I said, look, the market is in such unison that we are going to get a slowdown at best, maybe even a reversal at worst. Okay. And so the writing is already on the wall. It is time to do it. Take profit, exit positions. The market is warning us to take heed. These were very strong, very direct comments that we made, saying you need to go in there and take your profit. You need to exit your position. The market is warning us to take heed. If you don't do it, don't come back and say, oh, wow, nobody could have seen this happen, right? And the cool thing is that we weren't saying, oh, maybe take your profit and, hedge. No, we were saying, no, get out of the market is what we were saying. We didn't know that it was going to be the pandemic, but we just knew something was not right, right? And that's what we wrote about, okay? Uh, August is usually a bad month. You're absolutely correct, William. But again, you have to understand how to play this, all right? You have to understand how to play this. August is usually a bad month, but when in August does it begin is the question. When in August does it begin? Very good observation, by the way, okay? Um, so right now we have a market that is setting up for a rally, and you are absolutely correct. We expect it to get bad in August. That's just historical data, okay? But the question is when, all right? And that's what the platform will help you in. So after the market tanked in February, in March, you can see this report, March 23rd, March 27, 2020, when I wrote the report that weekend, I said, wait a second. The question is, have we found the bottom, or is this just a relief rally? Because we started seeing markets pull back up again. And it says the answer is the market is communicating that it is time to do what? Cover all short positions, exit all your shorts, and get ready for a rally. This was bold. For us, it was such a shocking situation because we did not expect it to happen that quickly. I mean, things are so bad. You guys all know this. It was so bad in March that it was like, nah, this can't be the bottom. It's too soon. Like, we thought it was going to drop even more, but we saw it. And I was like, what? So, but it was so shocking that even for us, we didn't actually start trading until about a week later on April 6th. Okay, so he's like, just to make sure that this was really what it is. And so by April 6th, we were telling everybody, buy, 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 buy. Right. And so while people were buying airline stocks, it was like, no, don't get into no airline stocks, get into these tech stocks, this is where the opportunities are. And we had a phenomenal comeback. And it was funny because as the market kept on rallying, I kept on hearing all these experts saying, oh, it's a bear market rally. It's a bear market rally. I say, no, it's not. It's like, my goodness, they don't know what we see. And that's when we started realizing, wow, we have something unique here. And so then by May, June, I said, you know what, I'm going to wait to see how long they start changing their tune. It became very fascinating to see what would they say. And then the NASDAQ hit all-time highs. And they said, well, it's just the NASDAQ. And then the S&P hit all-time highs. And I said, well, it's just the S&P. And then when the others started hitting, then it became, well, this is not fair. The economy hasn't recovered. The Wall Street guys are greedy. Why did all the stimulus plan go to the Wall Street guys and the poor people are still being poor? And I was like, no, the writing was there, just like the yield sign has been there, but nobody was paying attention to the yield sign and just kept on crashing over and over and over and over again. You don't have to run the red light anymore. You don't have to get into accidents anymore if you understand how to see the yield sign. And that's what this platform will do for you. Make sense? So, needless to say, it can help you see new trends, whether it's bullish or bearish, not in hindsight, but as it's actually happening. You know what action to take every single day, every single week, every single month, depending on the time frame that you want to trade. And You can scan for these stocks, so you don't have to be guessing which stocks to get into. So all this for the special price of $97 per month. I encourage you guys to try it out. Just try it out. What is 97? If you've lost more than $97 in the market, you owe it to yourself to just try it out, to see what this is all about, whether it makes sense or it doesn't make sense. Okay. And I hope that you take advantage of this, because this has really changed the way we approach the market. When the market tanks, we don't even worry about it anymore. We don't trade every single day anymore, because we've realized certain times when the market is ready to do something, and then we just go all in and sit back, manage it, and walk away. Okay. We will talk about how to trade shorts on the Tuesday night call. Does that make sense? We'll talk about how to trade shorts on the Tuesday night call. My time is up, so I apologize. I can't answer any more questions, but Jill, that's what we'll do. Okay. So thank you. You can see the link on the comment section. Thank you so much, David, for posting that on there. And again, thank you for having us on this call. I hope that you guys take advantage of this. This offer expires this Saturday, this Sunday night. So please take advantage of it. If you have any questions, let us know. Okay. And you can contact us at info@rightsidetrading.com. All right. I'm going to go ahead and turn it over to Dave. Thank you guys so much. I hope that you guys learned a lot from all the other presenters, and we'll see you soon.